Hello, everybody. Thank you all for joining. Thank you, Glenn. Thank you, Signal. Thanks all for coming. This is a big one. And Andy993, this show is probably one of the most alpha pack shows, but there's a lot of little life secrets in here. Not that every show isn't alpha packed, but big thank you to the Patreon community, because you are the ones that make me do all this work, provide all these answers, and it's really very inspiring for me. So thank you all for joining. Let's go. Again, very few people here, so think of the likes, or we can just keep these secrets to ourselves. That's fine too. I don't care. And a big warning here: this is not investment advice. This is edutainment. I do share what I do, but please do your own research, as they say. And where to ask questions, all the questions come from Patreon in the, executive, capitalist, and investor tier and above. And this week was brilliant. So big thank you for those questions. So we jump right in. And this was a fun one. Before we get into all the Bitcoin, and I'm going to analyze the Magnificent Seven, and literally the 60 plus slides here we have to get through. But this was a cool one. So this is from Matt D. And in the past, you've shown a model of different sized Bitcoin holders based off Sea Life, Whale, 10,000 Bitcoin, Shark, 1,000 Bitcoin, etc. Are you able to do the same model, but base it off Ethereum holders? Yes, I am. First of all, the Sea Life model you're talking about, that was not my creation, but this is my creation. So the one you're referring to, kind of what I did was I put together kind of a wealth pyramid for Bitcoin of how much you need to be in whatever animal class, which really a huge part of investing is about making a plan and building towards that plan. If you have no plan, you're not going to be successful. So we're going to talk a lot about planning today. But for you, Matt D, I built the new Ethereum wealth pyramid. Now, excuse the animals, I just wanted to try to give it a different flavor. And here it is. So at the top, we have whales. I chose the name whale and shark because I kind of like those. That is 10,000 ETH or more. Shark is 1,000 to 10,000. And I know technically it should be 9,999, but just take it as a rough thing. It doesn't really matter. Tuna, 100 to 1,000 ETH. Sardine, 10 to 100 ETH. And shrimp, 0.1 to 10 ETH. And plankton, less than 0.1 ETH. But what's really interesting is kind of based on the distribution of Ethereum holders, it is very uneven. And we'll talk more about this too. The top 10% of Ethereum holders control over 80% of the supply, which means there is a small number of whales have a disproportionately large amount of influence over the Ethereum ecosystem. This is dissimilar to Bitcoin, as we've done a lot of work on that too. But let's just jump in and show you some other charts I put together just to give you some perspective. So I stratified all of the holders, and it's kind of stunning to see. So nearly 40 million ETH are held by holders that hold 1 million plus ETH. So there's not many of them, but they have huge bags. Then you have 100,000 ETH to 1 million ETH. It's about 18.4 million. And then 10,000 ETH to 100K ETH, about 26 million. 1K ETH to 10K ETH, about 14.5 million. 100 ETH to 1,000 ETH, about 10.6 million. And then 10 ETH to 100 ETH, about 8.2 million. And 1 ETH to 10 ETH, about 5.2 million. And this data comes from Masari, if anybody's wondering. But what's really interesting is the uneven distribution. Let's dig into this for a little second here. You can see that 80% of the holders have over 2 million worth of ETH. That is crazy. 80% of Ethereum is held by people who have over $2 million worth of ETH, to make that perfectly clear. If you look at those with 0.1 ETH to 1 ETH, it is a tiny cohort making up 0.5%. And then 1 ETH to 10 ETH is only 4.3%. And then 10 ETH to 100 ETH is 6.7%. So you can see it is nowhere near as evenly distributed as Bitcoin. In addition, this is kind of funny, I always like to find patterns in numbers. You can see the Pareto efficiency kicking in here. The top 10% of ETH holders hold 80% of the supply, and 80% of ETH is held by people with a $2 million bag or more. And there's few small fish in this game. which is kind of stunning. There are new projects that are less than 3 years old that have nearly better distribution than this. So interesting to see. And I know people like Vitalik and others, a lot of the original OGs in Ethereum have huge positions. But anyway, hope that helps. They are our animals, and we added things like tunas and sardines and plankton to make it a little bit different. So I hope to see this popping up all over the Twitterverse soon. Now, next question is from Cosmo McKinley and TJ. This question came in from two people. So, ranking the Magnificent Seven, I've built a large position in Tesla. Great for you. But don't yet hold any of the others of the Magnificent Seven. If you could choose one of the remaining 6, which would it be and why? And would the recent Mag 7 Nasdaq rebalancing change the decision-making process? Great questions. Let's dig in. And of course, this is not going to be a full in-depth analysis of the top 7 that takes more time, but I'll show you some of the key things that I look at to determine if I want to invest or not, to kind of trigger my radar and what my threshold is. We'll talk a lot about thresholds today in today's video too. So first of all, I did a video on this over a week ago. The Nasdaq rebalance is a nothing burger. I think it was 2 Fridays ago. So don't worry about that. Very, very small effect, particularly for Tesla, as we saw. Now, the new Magnificent Seven, as a reminder of what they are, it's Apple, NVIDIA, Meta, Tesla, Google, Amazon, and Microsoft. And for those who don't know, Alphabet is Google, one and the same thing. Now, I'm going to break down the top 7 and look at revenue growth and earnings growth out to 2025 to give you a feel of exactly what's going on. So this is Apple, first of all, in the box. And you guys know I don't like companies that have slow growth. But here, yeah, revenue is picking up a bit, depending on that $5,000 whatever headset they're selling or whatever it is, I can't remember. But earnings are forecast to grow only by 6% per year. So as far as I'm concerned, that's not disruption. So that wouldn't be getting my dollars. Let's look at Google. Number 2 on the list. They are trading at about 20% below kind of fair value as I see it. And earnings are growing at 13.7% per year. Not bad, better. Let's look at Amazon growth now. It's about 20% below fair value based on our numbers. But what's important here is earnings are forecast to grow at 36.9% per year. Wow, 36.9% earnings growth is huge. It's really impressive. But remember, you have to look at the graphics. I'm going to zoom in again. You can see how they're starting at a negative base. So they were actually loss-making because of write-offs of some of their investments, and that took them down. So it's easy to go from, say, 5 cents of profit to 8 cents of profit. That's 36%. But given their amount of revenue, it's actually not very good. So therefore, Amazon is there. That's why one of the reasons I don't hold it. Let's look at Microsoft. Now, Microsoft, their price to earnings ratio is about 34, which is in traditional markets considered expensive, but the software industry is now trading about 47. So it's cheaper than the average software industry. But remember, it's nearly a $3 trillion company. It's huge. And earnings are forecast to grow by 11% per year. Again, 11 doesn't get me excited. Let's look at Meta. Interesting one here, trading at about 20%, 22% below fair value. Earnings are forecast to grow at 19.5% per year. Now that's more like it. I like it. And the beauty of Meta, we'll talk more about Meta as well in a minute because it's related to another question that came in a week ago in Patreon. But that is the type of juice we like. Let's look at Tesla. Obviously my biggest position. Tesla are forecast to grow 21.6% per year. Earnings grow by 29%. So, but in reality, the earnings growth will be a lot higher than that, I estimate, because they have so much attribution coming from so many revenue lines. I'll talk about that a little bit later in answer to another question, why they have something like 28 startups inside one company, and each one makes money or will be making money in the future. Now, NVIDIA, the other big shining star of the year, earnings are forecast to grow 31.72% per year. Bonkers growth, okay? But the problem is that's priced into the stock already. I have a little bit of NVIDIA, but I sold literally 80 to 90% of it and found a leap or a synthetic long in another account somewhere. So weird background story on that one. So let's talk about the summary of where we are. So I go for growth and valuation. So you can have very high growth, but it can be priced into stock. Therefore, it can nix certain things from me. So NVIDIA has great growth, but it's all priced in. Buying that at 150, 160 last year was the deal. Meta has great growth and a cheap valuation. But regarding Meta, that was trading at a PE of 7 back in October. And I'll show you the trade based on that. I was just looking at PE of 7. Geez, that's silly, stupid numbers. Anyway, Apple, Amazon, Google are not growing fast enough for my liking. And Tesla is the best all-round growth and profit potential. Meta is second. And in full disclosure, I own Meta, Tesla, and Google. Sold 60% of it this year. 60% of my Google position. And I've held Google for a long time. So it's hard to break with that, but I'm flipping it into other assets that people know within Patreon. So let's talk about Meta, because this kind of answers two questions that are beyond the other questions. So this is the Meta trade, and when we jumped in, obviously what's interesting about this, Meta is up 260% in 267 days. That is incredible return. So everybody, please don't expect those type of returns in equities. It's very rare that it happens, and it takes a nasty bear market to get these opportunities. And I call it running into a burning building when you see things like that. And that's what I do. And this is the trade. Before I share another question, actually, let's go to the question first, because people say, oh, that's impossible. Now, I know a lot of other channels brag about their trades and everything else, but I do publish all mine in real time to Patreon, so everybody knows exactly what I'm doing, every transfer, every move. But this was an extraordinary bear market, and this is a real post as well from my brokerage account today. And I don't talk about this much stuff. I focus much more on educating others, helping them achieve financial freedom. And I focus on walking the walk, no hot air, not anything else. And by the way, this was not the only trade like this I did over the last 8 months. I did many of them. Now, this is the question came in from Patreon. How can I turn 20,000 into 1 million? Well, this trade is even better. If you just invested 8,000, you could get to $500,000, or 16K, $1 million. So that beats the 20K into 1 million. And obviously people want to do that, but I must stress, it's very rare that you get these opportunities. So this was a net debit per contract of $4, strike $100 for Meta out to January 2024. So they're 6 months away from expiring. The value of each contract now is 23 grand. The ROI is 5,650%, or it's a 58 bagger, and it's really big. And for those who don't believe, everything's published live. This was the actual post on October 27th, 2022. And again, these things are possible, but it's rare to get a 60 bagger. 10 baggers I can do all the time. 60 baggers are harder, but it was a very special bear market. That's why in October and November and December and January, I couldn't stop smiling, because I knew things were beyond oversold. We got this model called mean reversion, and you could see that there was like literally 1 in 10 year events were happening before my very eyes. And I was like, woohoo, looking behind the couch, pulling pennies from everywhere and flipping pristine assets into things to make these trades happen. Anyway, enough of that. Next question. Main stage news. This is a very, very important one as well, because a lot of people no longer want to be so-called wage slaves, working for the man, crummy salary, no raises, etc. A lot of people, including main stage news, who we are very close to in the community, said, I'm considering starting a business in a year. I'm currently saving heavily, but I'm heavy risk assets, Tesla, Bitcoin, and Sol. But once one quits their day job, I'm curious on what your strategy would be. First of all, there is nothing more rewarding than being an entrepreneur, not working for the man. It's extremely difficult to make life-changing money working for somebody. Very difficult, unless you become literally a senior vice president or a CEO of a Fortune 100 company. It's hard to do because the tax man takes so much, etc., etc. But these are the kind of life lessons that I would offer up to you. And they're very, very important. So first of all, advice before you quit your day job or before you start your business is make sure you have enough savings to cover your living expenses for at least 6 months. And this will give you a cushion in case your business doesn't start generating income as quickly as you expect. Second, Make sure you have source of perpetual income. For example, a rental unit is a very good way of doing this, or a consulting gig, something just to kind of keep the cash coming in, keep the lights on until your business grows fast enough. Also, it takes time to get to the cash flow positive status. In addition, so important, control your burn, live cheap. Do not, if you are starting a business, do not waste money on vacations or luxuries or new cars or anything else. You want to be on the ramen noodle plan, as I call it. You want to be buying your Starbucks coffee at Costco, which I still do. I don't need to, but I do, etc. So that is just so important. Control that burn. Control your rent. Reduce your living expenses as much as you can. That is probably the most important thing on this list. Next is have a clear plan for your business. You know, what your product or service is. What is your target market? Understand that market code. How will you reach your target market, and how you will make money. And also build a network of support. This includes family, friends, mentors, and other entrepreneurs. Having a network of people who can support you will be invaluable as you navigate the challenges of starting a business. And the other piece, which is kind of a rude awakening to many, but be prepared to work very hard. I am long retired and I still work 70 to 80 hours a week, despite the fact I don't have to. But starting a business is a lot of work, and to be successful, you got to outwork everybody else. And there will be long hours and lots of challenges and lots of decision making that needs to be made. But the other thing that's probably most important, other than controlling your burn, is you have to be passionate about what you do. If you love what you do, it's a pleasure to do it. Like me, I do this because I love kind of helping others. So again, be prepared for that. So that is the advice. Next question is from Not Michael Burry. I love that name. It's hilarious. The two hosts of another YouTube show. By the way, I am not disclosing their names just because I don't want to name any names. And as far as I'm concerned, we are all in this together. We are all one community and we are all one family. However, my strategies, my view of the markets, my experience in the markets, my methods are very different to others out there. I always say, blaze your own trail. Interpret data differently to everybody else. So anyway, these two hosts of another YouTube show are convinced that there is no real bull run happening or possible until still active stimulus liquidity is sufficiently drained. Point number one. Two, no bull run until we reach unemployment pain and the S&P gets crushed to around 3,000 and risk assets, including Bitcoin, capitulate dramatically. And number three, and that 2% inflation is Jerome Powell's white whale. He'd rather wreck the economy than chance lingering inflation. What say you? From Not Michael Burry. I love this question, and let me just explain, again, not naming any names, how I see the market. First of all, the definition of a bull run, let's jump into the beginning, make sure we address every single point, because this is a bit of a very deep question. There is no one definition of a bull run, but typically, it's considered to be a period of at least 20% price appreciation. And for crypto, you've heard me say this before, I double it to 40%. So once you get off the bottom and you're 20% off the bottom in equities, it's a bull run. In crypto, you got to be 40% off the bottom to be a bull run. And I believe we are 8 months at least into the early Bitcoin bull run. No doubt about that. So could be wrong. There could be a nasty black swan that could kill us all like World War III, and then I'm wrong. But as long as things chug along the way they are, this is a bloody great bull run. Next, no real bull run is happening or possible until still active stimulus liquidity is sufficiently drained. So first of all, it's very important. This run is not driven by the US markets. Maybe US equities are, but crypto definitely not. And this run is not driven by retail stimmy checks. So it's very different. I believe this run is driven by Asia. It's driven by institutional buying. And it's also broad-based. People are stacking all over the world. And that's very clear from on-chain. I spend an inordinate amount of time every single day looking at on-chain analytics. Next, let's look at Bitcoin. So Bitcoin did shoot up 101% in 234 days. That is not a bull run. That is 2.5 times a bull run using my 40% off the bottom metric. Okay. So again, over 100%, 234 days. pretty good. It has dipped a little bit down, as you can see here from the chart. But if you're waiting for things to crash, no, especially after such crazy returns. But it gets better. There's more. No bull run until we reach unemployment pain. The S&P gets crushed to 3,000 points, and risk assets, including Bitcoin, capitulate dramatically. Again, this run is not defined by retail, in my opinion. Many live paycheck to paycheck. They don't have the type of money to move the markets anyway. Second, and I've done many videos about this, the labor market is structurally different since 2020. And I can show you 100 charts to point to that. A lot of people quit, retired, early resignation, quiet quitting, etc. There's so much change. A lot of people have 3 jobs, etc. Very different. And the stock market is now nudging 4,600, way off of 3,000. A dip to 3,000 would mean basically a 35% fall. I don't see that unless there is World War III, like I mentioned before. And the host thesis, who will remain nameless, said also that the S&P 500 would be flat for a decade. That's already proven to be false. And other things like gold would be the best performing asset. You know, gold is garbage. I always said that from day one. Let's look at this one. Is kind of important because there are elements of the labor market versus the soft landing that we need to dig into, and it gets a little bit tricky here. So since you did mention crushing labor, yes, well, you know my thoughts on that. I do believe high-paying jobs are being replaced by lower-paying ones, and I believe many people have 3 jobs. For example, I know a person who is a personal trainer in the morning, works at a coffee shop until 4 p.m., and then drives Uber Eats at night. 3 jobs, 1 person. Okay. Now, this is where it gets tricky. So what we're looking at here is kind of, if you imagine the Beveridge curve, this is a curve that shows the relationship between the number of job openings and the unemployment rate. And the Phillips curve is a curve that shows the relationship between inflation and unemployment. When you mash them both together, there is a way out. And I explain why. The unemployment rate is low right now. And there are lots of job openings, but they're all crappy minimum wage jobs. There's no like $250,000 salary jobs out there. Very rare, very few and far between. But that means, though, if some of these job openings do close, it won't cause a big increase in unemployment. Additionally, if inflation, as it is right now, it can weather a small increase in unemployment, which could help kind of bring it down too. And people aren't demanding kind of high salaries, etc., work from home, all that stuff. So this is kind of tricky, but taken together, the 2 fitted curves clarify a potential, although not guaranteed, of a soft landing for the economy. Let's talk about the S&P 500 for a sec. So it's a very deep question, so it requires a lot of explanation. This is pretty amazing. In January 2023, my S&P target for year end, that was December 2023, was 46.86, again, published. And people called me Hopium Boy. Well, we're 6% away from that target. 6% after a 31% run. So, you know, are we going to 3,000? No. And the 2% inflation, this is interesting. I do believe, you know, the 2% is something that is kind of a white whale. We agree on that. But the soft landing is possible. Remember, a lot of people kind of have gig economy type jobs. But the soft landing is possible. Earnings expectations were in the toilet for big businesses, but now it's easy to beat. So the stocks are up and the market is crushing earnings expectations. And finally, as I've always said, JP does not control inflation. All right. If a supply chain breaks, which he does not control, prices go up. If the system is flooded with cash from money printing, prices go up. If OPEC cut production, oil prices goes up, which drives inflation up, etc., etc. He doesn't control those key factors that drive inflation, but he does destroy demand. That's what he can do. And he's making it very painful now for commercial real estate, for banks, etc. So we kind of sort of agree on the last piece, but let's just look at some performance off the bottom of some crypto assets, because I'm talking about the S&P 500 and crypto, etc. But look at these numbers from the crypto compendium. Does this look like a bear market to you? Injective up 605%, Render up 530%, Lido 378%, Optimism 268%, Solana 202%, The Graph 115%, Ethereum 107%, That's from 6/18/2022. It has the current cycle low. That's a model that we actually build into our model to determine exactly when the kind of bottom was for certain assets. Bitcoin, 11/21/2022. By the way, it's interesting to see how ETH and Bitcoin had different lows at different times. That's kind of rare for it to be so far off, nearly 6 months apart. But you can see 87%. Chainlink is 55%. And I threw in Cardano there as well because, according to my definition, it's not in a bull run yet because it needs to be 40%. And it's only 30% off the cycle low from 10th of June. So that is the view of the world. I do not agree with the other group. So hope that helps. Next question from Lucky Dragon. This was another great question. Is BlackRock worth adding to our equity portfolio? Will their value significantly increase once their Bitcoin ETF is approved? Interesting. So let's dig into the numbers as we do. So first of all, BlackRock valuation, it is currently overvalued by about 13.8%. So not a big opportunity there. Let's look at earnings growth because we are in the habit of looking at earnings growth. You can see it's kind of small, runs around 8%, 6 to 8%, depending on the season. So it's not a disruptive stock. BlackRock 1-year target from a combination of about 26 different analysts is $807. That's a 9% upside from where we are today. So again, I don't get out of bed for 6%. Probably not 9% either. I wouldn't invest there. And the big question, though, was really going back to if they do get the Bitcoin ETF and if they are approved first, how much of a boon could it be for the business? Well, let's look at the analog, which is the iShares Gold Trust, which is the BlackRock ETF, BlackRock own iShares. So their expense ratio, the amount of money they get for assets under management, is 0.4%. Total asset under management of IAU is $229.7 billion. This means that iShares collects about $919.8 million in fees per year from this ETF. Now, assuming expenses are 50% of the fees, profit is $459.9 million per year, and that is 8.6% of the total profit of BlackRock. So not that big at all. And remember, there are an army of like 10,000 salespeople that sell this stuff to other people. So there are that 50% expenses. I could be wrong on the 50% expense. It could be 75%. It could be 40%, but it's somewhere kind of in that range. And if they do get Bitcoin, they're not going to be turning it into a, $230 billion asset under management overnight. That'll take time to get there. Now let's look at return on capital employed. And now I look at this because it's a measure of how efficiently it is using its capital to generate profits. And it's generated by dividing a company's net profit by its capital employed. Some people call it ROCE. Means that a company is generating a lot of profit from its capital. For example, that's Tesla on the right. They generate 20.1% last year on their capital, whereas BlackRock only generate 5.4%. So what I invest? Again, no. We're looking at a lot of this type of stuff I look at to determine if I would invest. So that's the answer to that. But we have another question that's related to BlackRock as to how much you would pump the Bitcoin price. We'll get to that in a second. Next question is from Internet Exploder. Contrarian question. Could Bitcoin's extreme scarcity actually work against broad adoption? Brilliant. So I think about this a lot, and let's dig in. So it's like a double-edged sword. It has some negatives. It has some positives too. So first of all, limited supply and high prices means Bitcoin scarcity could drive up its price, making it difficult for the average individuals to afford. We know that time is coming. Also, deflationary pressure, Bitcoin scarcity could deter spending as people may hoard their Bitcoins. We're already seeing that happening. Nearly 80% is being hoarded right now in the hope that their value would increase over time. Yep, long-term holders are doing just that. Unit bias, dealing with fractions of a Bitcoin might be off-putting for some users, i.e. they want to own a full Bitcoin, not like 200,000 Satoshis or something. Also, scarcity drives volatility. Bitcoin, because it's so thinly traded, if there is a lot of demand, it could bring about very volatile price, making it challenging for things like merchants and consumers to handle it in day-to-day transactions, which could be a ding for it too. Also, competing currencies. There's a lot of other cryptocurrencies that offer greater supply or flexibility for everyday transactions like ETH, SOL, etc. And also, there's an incentive for alternatives. Limited supply of Bitcoin could lead to the development of alternative cryptocurrencies that address shortcomings. We've seen some of this happen in the past with BSV, BCH, etc., etc. They are not Bitcoin. They're knockoffs. They're forks. So, different situation. But let's talk about scarcity for a second, because this is important. This is the other side of the coin. So, scarcity, especially extreme scarcity, drives up price. It drives up cachet value, and scarcity drives value because it creates demand. If you limit the supply of something, for example, diamonds or Gucci purses, people are more likely to want it, which drives up the price. That person on the right, some people actually drop a comment below if you know who that is. That's a $30,000 suit. Okay, $30,000 because it's rare. I personally don't get it. I'm fine shopping at discount stores and buying a shirt for $20 instead of $30,000. I'd rather take that $30,000 and buy Bitcoin and Tesla stock. I actually become a whole coiner with the cost of that suit. So anyway, I believe, well, I've got nothing to prove anyway. So does anyone know who that is? Let me know below. I'll zoom into it again. But yeah, you wouldn't catch me dead being dressed like that. Anywho, next question. I told you there's a big show today. How do you calculate the compendium score, and why is it important to be above 6.5? From Royal Councils. So there's about 69 different parameters that go into the compendium score. It is a big monster database. Same with the SCP profiler. They feed off tons of different data feeds, APIs. There's a dev team that actually manages it, keeps it alive, makes sure all the links and data are working and all the models are calculating correctly. And there's a whole bunch of composite scores to reflect it. But I'm not going to show you how that sausage is made. It's pretty tricky and beyond the scope of this Q&A, but I can show you why 6.5 is important. So this is the top 500 cryptos with their final CC score. CC is Crypto Compendium. And I like this 10% thing. I do everything kind of in ratios and numbers because that is my training, that is my discipline, and it comes from my investing discipline in equities. And you'll notice that a lot of the stuff that has made me successful in analyzing equities, I apply to crypto. That's why we have the SCP profiler, the IA engine, and the compendium here as well. But if you look here, investing in the top 10 percentile of stocks historically has been very rewarding. I call them black holes. These companies always yield the highest returns in most cases. They have strong profitability, growth prospects, and they stand out in the market. Now, there was a study I read years ago by Dalbar, and if you invest in an average, say, S&P 500, and this is why we chose 500 as well for this, kind of like to mimic the S&P 500, the average stock returns 6%, okay? But the top 10% of stocks return 20% on average, okay? So that's more than 3.5 times the typical return. And they have exceptional profitability, leadership teams, they generate substantial cash flow that can be reinvested. They have solid leadership, etc., etc., and proven track records. So again, top quality companies, top quality cryptos, what you need to focus on. Focus on the 10%. Now, if you look at the S&P 500, 7 companies drove like 60, 70% of the returns. 7, and the other 493 didn't do butkus. That is the interesting part. See all the stuff under that line? You don't want to meddle with that at all. Now, crypto is irrational. Crypto doesn't look at fundamentals like I do, but there'll come a day where this is already proven to survive very well during the last bear market. And I believe it'll do even better over the future. So that's why, top 10%. Next question is from 1213. And I love these questions. I want to thank everybody again for giving me all these tough questions. The harder, the better. Can you please provide an understanding on the pricing mechanism for Bitcoin? For example, how much does a $1 million inflow, outflow move the price? And is the multiple you use variable or fixed? And why is there a calculation for total inflows at a total given price? Yes, there is. So if let's just jump in and show you some of my models. I have a thing called the 21x multiplier. I was able to calculate it after Tesla bought Bitcoin. They spent $1.5 billion in Bitcoin. I could determine exactly the impact on Bitcoin price based on that influx of $1.5 billion. So that's where I get this. Now, if you imagine, and this is a slide from 2022, and from early days of talking about BlackRock, but if they put in $50 billion, we got 10 trillion assets under management, half of 1% is 50 billion times 21. That would impact the price of Bitcoin by 75 grand, take it to 102,000. Again, slide is a year old, but let's take it to today and have a look at what it looks like. Using the same multiplier, 0.5%, $50 billion, spend, etc., multiplier, that would take the price, potential future price of Bitcoin, if half of 1% of the assets under management from BlackRock went into Bitcoin, it would take us up to about $82,000, which is 172% from here. Not bad. Let's throw in a new wild card, which came out this week from, and I covered this briefly yesterday, is from the FundStrat team, Tom Lee and co. What they did was they looked at the current Bitcoin market and how they believe it is in balance. That means there's $25 million worth of Bitcoin in daily block rewards, and there's about 25 million in daily demand. That means 25 million is being created, 25 million is being absorbed, so the price remains flat, and that's where we are right now. But there's more. So if we look at how this works, if there's incremental ETF demand, one of the team on FundStrat, Sean Farrell, believes that 25 billion of demand, of course, is possible for the forthcoming future. And if Bitcoin come in, that will drive $100 million in daily demand. A 100 million on top of the 125 million. So the equilibrium price, if the daily demand for Bitcoin increases to 125 million, that's 25 plus 100, and the daily supply is only 25 million, the implied equilibrium price would need to rise so that the daily supply matches daily demand. And equilibrium analysis suggests that the clearing price is 180,000 before the 2024 halving. Again, if BlackRock comes in and if BlackRock brings about an increased incremental demand of $100 million of buying a day for Bitcoin. Okay, let's take this and bring it back to my model of 21x multiplier and see how it compares. But what we're going to do is we're going to do it for all the top asset managers in the world. Fidelity, Charles Schwab, Citadel, Deutsche Bank, BlackRock, and Nomura. These 6 run about 27 million in assets under management. And what does that work out to in the model? Real simple. So if they all, that 27 trillion, if they plump in half of 1%, which I do believe they will do over time, they have to, and that's a lot less than what they typically do for gold, that'll be about $135 billion times the 21 multiplier is 2.8 trillion. And the impact on the price of Bitcoin is 202,000. And that'll take the price of Bitcoin up to 229,500 or a 665% increase from where it is today. Make any sense? So again, that assumes those top 6 asset managers allocate half of 1% to Bitcoin. That's where the price of Bitcoin will go. If I was to use the numbers from FundStrat and Tom Lee, it would be a lot higher. Mine is more conservative. Hope that helps. Next question. A lot of contrarian questions today. This is from John9244. You've given us many reasons to be bullish on Tesla. One of my concerns is lawsuits arriving from FSD. It only takes one lawsuit with ample media coverage to cripple the stock. Accidents happen no matter how hard we try and avoid them. Accidents will be less with FSD, but will still occur. Isn't this a big concern for investors? Great question. And I love the way you're thinking. You always need to be able to look behind the wall and question your thesis all the time. Could this tank Tesla stock? So first of all, and this is a famous football coach, let me know if you know who he is. And I call it the 17th rule of investing. Scared money, don't make money, you know? So sometimes people can be over concerned about things they don't need to be concerned about, like World War III. If you're worried about World War III happening, you're not in the market, that's probably a mistake. Same thing for this. If you're worried about FSD crippling Tesla, you're making a mistake. Let me explain why. So Tesla rule number one of Tesla FSD is to avoid crashes, or they call it crash avoidance. The system is designed to avoid accidents at all costs. And to do this, the system uses a variety of sensors, cameras, radar, ultrasonic sensors, etc., to gather information about the surrounding environment. And the system uses this information to make predictions about what other vehicles and objects are going to do. And this is why it is a true AGI use case. And that is, as far as I'm concerned, Tesla is a pure play AI play. But if the system determines that there is potential for a crash, it will take action to avoid it. And in a fraction of a millisecond, it will determine the best course. And that could include braking, steering, or taking evasive action. I remember I used to do crazy things on motorbikes for a long time. And a very famous racer once told me, he said, there's two ways of getting out of an accident on a motorbike. One is brake. But when you brake, you got no control. Number two is accelerate. Sometimes you got to accelerate to get out of the way. Anyway, separate issue. Number two, this is accident avoidance is the number one pillar of FSD. Ross Gerber asked Elon Musk, just to note, there has not been one accident or injury since FSD beta launched. Not one. Not a single one. In that time, 20,000 people have died on the roads in car accidents. Correct, Elon Musk? Knock on wood. And Elon Musk said, yes, correct. So that is first part. Accidents will happen, yes. But Tesla rule number two is build the safest car possible. This car fell off a cliff not far from where I live and landed on rocks. It had two adults and two little kids in the back. Everybody walked away. Okay? And the emergency services that went on site could not believe that they heard voices coming from the car. Any other car would have exploded. But before it exploded, everybody would have been dead anyway from the impact. Everybody survived in this car. Model Y, off a cliff, 300 feet down, into rocks. In addition, Tesla with FSD is more safe, 6x more safe than driving. So on this chart that I put together, these are the miles driven with no crashes. You can see that a typical Tesla with FSD will drive 6 million miles without a crash. Whereas another car, the average US car, will drive, I think it's 200,000 miles without a crash. So it's a very, very different kind of kettle of fish. In addition, the safety factor, which is the yellow box, it is 6.2 times safer for FSD than any other conventional car. And all of this statistics is from Tesla on the Tesla website. Go check it out. Pretty stunning. So with that, let's look at one other thing as well. Tesla is not just a car company, as a lot of people think. It is 19 startups in one company. And they do insurance as well. Okay. Cars, trucks, semis, Tesla service, seats, infotainment, FSD chip, Dojo beta, autopilot beta, vision tech, beta, insurance. The insurance. They will be holding the bag for their own vehicles. And because their vehicles are safer, they can completely cut the knees off Geico, Progressive, all the traditional incumbents. If I was an insurance company, I would be quaking in my boots. They have an app store. It's very early, robo-taxis coming, superchargers, mega chargers, solar panels, tiles, walls, power walls, grid services, batteries, auto bidder, blah, blah, blah. I mean, the list is kind of incredible. And I'm not even talking about Starlink, SpaceX, XAI, all the other stuff that's coming. It's just, anyway, yeah, they got this covered. So with those combination of factors, don't let the fear of a lawsuit from FSD scare you out. Yes, it's invariable, accidents will happen, but something like 55,000 people in the US die on the roads. I have no idea how many it is around the world, but it's probably another 600,000 people that die in accidents all the time. These cars prevent death in many ways. So big thank you as well. Helping animals this week. Coyotes are often considered vermin or dangerous animals, despite the fact it's typically not true. Coyotes are widely hunted, sadly, and mistreated in the US. And this is Maine. He is a coyote. He's a simple guy, like me, who likes treats, lying in the sun and splashing in his tub. He does not drink coffee, however, so hope that helps. And if you want to amplify your intelligence, the world is changing very fast. The next 3 years will be redonkulous. you need to subscribe to this channel if you want to stay ahead of what's going on in the world. So I'm going to do some live questions right now. Oh, by the way, DCA is tomorrow on Ivan's channel. We couldn't do it last week because of midsummer in Sweden and people in planes and stuff, but we should be on Ivan's tomorrow. If not, CTO and I will definitely be around. So that is if Ivan is still stuck in the plane. Hope he's back. So this question is from Black Barbie. What do you think about 1 billion per Bitcoin prediction by Fidelity? It's very possible. If you look at the asset class itself, it's so small and it's so scarce. The penetration, by my calculations, is less than half of the population of the world. So once the world starts coming on board, I mean, it's going to be like a crazy S-curve. Once you get to 3%, 5% penetration globally, it's hard. There is no extra supply. It's the only asset that's just so hard. And that's why I am fascinated by Bitcoin. So 1 billion per Bitcoin, that is in my models, but not until like 2038 or so, 2042, way out there. But remember as well, $1 billion in the year 2038 will probably be worth 200 million or something, maybe a lot less, maybe 10 million. Who knows with the amount of money printing that's going to happen. So you got to start measuring Bitcoin against something that doesn't debase as fast as fiat. Michael, where do you see Tesla stock going over the summer? Will there be more opportunities to stack below $200, or are they likely to announce the new model soon and it will send the stock into the stratosphere? So there's just, when I look at the tailwinds right now for Tesla, it's frightening. I mean, if you're on a boat, you pop a spinnaker, you'd be doing 25 knots downwind. So they have Cybertruck, like literally it's imminent. The truck that people said was never going to happen, just like the semi is never going to happen, is happening. And that's just going to completely devastate over time a lot of the legacy ice makers that depend on pickup trucks for a living. Then we have FSD 11.4. I haven't gotten it yet. I keep checking every day. I can't remember the exact version, but also version 12 is coming where it's learning by itself with the Dojo computer and 100x flops of processing compute. That's going to be a game changer. The Model 2, the Highland, I mean, it's just so do we get under $200 again? I don't know. I was hoping we get to 250 or a little beneath 250. And it may happen if there is like an event in the market. Sometimes people just sell everything and move to cash. We might be there, but 200 I think is probably a little bit unlikely right now. Sub 250 is where I stack. Chaotic Coder, one thing I would love for you to do a video on is how many of the Retire On series would change without the primary actors, Elon and Saylor. That's an interesting one. Like if there was no Bitcoin and there was no Tesla, what would we retire on? Well, we'd have other assets too, you know, ETH and Solana and other things that I believe will be very changing for the world as we go forward. But let me think about that. I have promised a cocktail. I was hoping to do the cocktail when the prices kind of dip because I don't want to dishearten people from their plans. But a cocktail is ready, real ready. The Pool Man, why must always Bitcoin go up for ETH to go up as well? Why can't ETH just go up by itself? In fact, that has not been the case. I'm wondering, well, Bitcoin's going down right now as we speak. I wonder if I can pop a chart real quick. Yeah, I can. So, just looking here. Let me see if I can pop these. And bear with me 1 second. I gotta pop up my trading view and see if you can see this. So this is the Bitcoin divided by ETH chart. And you can see that ETH has been stronger than Bitcoin since, let me see, since beginning of June. So from that perspective, yeah, ETH has been outperforming. So they are beginning to run counter. And there will come a time where they become completely disjointed because they are very, very different assets. In fact, that's why the whole crypto market cap and Bitcoin dominance to me kind of makes little sense. Not a lot of sense, but it's interesting to look at, but kind of crazy. So from that perspective, yes, they do change, Mr. Poolman. But by the way, as well, you know, Bitcoin is the 800-pound gorilla. And when it goes up, the market thinks it should follow. When it goes down, the market thinks it should follow. In fact, Bitcoin has just dipped $100 since I started this stream. It's gone down, and you can see everything else goes down. But also, it's interesting. So Bitcoin falls by 0.7%, ETH falls by 1%, and Solana falls by 3%. So you can see that those same ratios actually will be how they will outperform each other over time as well in the future. So you can watch how they move, measure the movements, and then it'll tell you exactly which one will go up much further. SAS Finance. I did the math, James. You don't need to hit the bottom on the alt Bitcoin pair because of the upside. Obviously, it depends on where the final bottom is and what altcoin you're talking about. Definitely, yes. So things like pairs, you have to look at them as the assets change. Sometimes you get it like during a bear market, you get beautiful range riders up and down. But we know ETH is going to outperform Bitcoin. We know Sol is going to outperform ETH. So having that pair over time will gradually ascend upwards. So you are dead right there too. And thank you as well for your super sticker before my voice dies. Andy Glenn Johnson, Signal 103, Andy 993. Lots of Andys. To all the Andrews out there. The Great Escape, Jeff Hammer. Thank you, boss. Crypto Katana. Wow, there's a crypto sword now. That's interesting. Dog One and SAS Finance. Appreciate each and every one of you. We have nearly 2,000 people watching live. Thank you so much, everybody. Thank you also for hitting the likes. Much appreciated. And hope you enjoyed the alpha session. And I'll see you all tomorrow morning early. 7:30 a.m. Pacific, 4:30 Swedish time, Central European time too. Okay, thanks all. Bye.